What's up, everybody? Today we're diving into building a serious, tax-free, passive income stream for Canadians. We're talking about using dividend-paying ETFs inside your TFSA, the ultimate financial cheat code. You get instant diversification, zero tax on dividends, and no need to pick individual stocks. We'll break down 3 Canadian dividend ETF strategies, from broad market to specialized income boosters. Grab a coffee and let's get started. Alright, let's dive into some specific ETFs that can help you build that sweet dividend income stream. First up is the iShares S&P/TSX Composite High Dividend Index ETF CDZ. This ETF is a popular choice for Canadian investors looking for a simple way to access a diversified portfolio of high-yielding stocks. It's a great starting point for those new to dividend investing, offering instant diversification and a relatively hands-off approach. CDZ gives you exposure to approximately 75 of the top-yielding Canadian stocks. These aren't just any stocks. They're carefully selected based on their dividend yields and financial health. This means you're investing in companies that are committed to returning value to their shareholders through consistent dividend payments. The fund rebalances periodically to ensure it continues to hold the highest-yielding stocks that meet its criteria, across key sectors like financials, which often make up a significant portion of the Canadian market. Energy, a crucial component of the Canadian economy, and utilities, providing essential services. These sectors are known for their stable cash flows and consistent dividend payouts, making them ideal for income-seeking investors. With one purchase, you're instantly diversified across these sectors and numerous companies, significantly reducing your risk compared to investing in individual stocks. This diversification protects you if any single company or sector struggles, as the impact on your overall portfolio will be minimized. It's a cornerstone of sound investment strategy. The dividend yield is typically around 4.5%, which is quite attractive in today's low-interest rate environment. Keep in mind that dividend yields can fluctuate based on market conditions and the performance of the underlying companies. So, a $10,000 investment could net you $400, $450 a year, tax-free in your TFSA or tax-free savings account. This tax-advantaged account allows your investment earnings, including dividends, to grow without being taxed, making it an excellent vehicle for building long-term wealth. The MER, or Management Expense Ratio, is 0.66%, a bit higher than some broad market ETFs, but you're paying for the convenience of instant diversification and the expertise of professional fund managers who actively screen for high dividend-paying stocks. This active management aims to provide a higher yield than you might achieve by simply investing in a broad market index. CDZ is a simple, reliable way to start dividend investing without requiring you to conduct deep research into individual companies. It's a great option for beginner investors who want to generate passive income without the complexities of stock picking. The main drawback? Higher fees compared to some other ETFs and a possible overexposure to certain sectors like financials, which can make the fund more sensitive to fluctuations in those industries. It's not built for explosive growth, aiming instead for steady, dependable income through consistent dividend payments. This makes it a suitable choice for investors who prioritize income over capital appreciation. Think of CDZ as the Toyota Camry of Canadian dividend ETFs, dependable, reliable, and perfect for building a solid passive income foundation. It's a workhorse that consistently delivers without the flash or risk of more speculative investments. Use it as your core holding in your dividend portfolio, then layer on more specialized strategies, such as individual stock picks or sector-specific ETFs, if you want to further customize your income stream and potentially increase your returns. It's a great base upon which to build a diversified and income-generating portfolio. Are you looking to fine-tune your investment strategy? Perhaps you have a strong conviction about a particular area of the market. Want to focus on a specific sector like financials, technology, or healthcare? Let's talk about a specific example. The BMO Equal Weight Banks Index ETF, ZEB. This exchange-traded fund offers a targeted approach to investing within the Canadian financial sector. ZEB invests equally in Canada's Big Six banks. This equal weighting strategy ensures that your investment isn't overly reliant on the performance of any single institution. These banks are known for their stability, robust regulatory oversight, and history of providing strong dividends to their shareholders. They form the bedrock of the Canadian financial system, the yield is often 4 or 5%, making it an attractive option for income-seeking investors. This yield can provide a steady stream of income while you benefit from potential capital appreciation, and the MER, or management expense ratio, is just 0.28%, much lower than CDZ, another Canadian bank ETF. This lower MER translates to more of your investment return staying in your pocket. This ETF is particularly well suited for those who are confident in the long-term strength and prospects of Canadian banks. It's a way to express a bullish outlook on the financial sector. But what's the risk? You're heavily concentrated in one sector, the financial sector. So, if banks encounter significant challenges, such as a housing market downturn or rising interest rates impacting loan portfolios, your investment will likely suffer. But if you believe strongly in the enduring strength and stability of Canadian financials and their ability to navigate economic cycles, ZEB can be a powerful core holding, forming the foundation of your portfolio or a satellite holding used to strategically overweight a specific sector. By investing in ZEB, you're essentially trading broad diversification across numerous sectors for a more focused approach, targeting high-quality dividend income from a specific segment of the market. Just remember, sector bets can significantly boost your returns if the sector performs well, capitalizing on specific market trends and opportunities, but also substantially increase your overall portfolio risk as your investment's performance becomes closely tied to the fortunes of that single sector. Ultimately, ZEB is most suitable for investors who have a strong conviction and want to double down on the long-term prospects of Canada's financial backbone. Now let's explore a strategy to potentially ramp up your income stream from your investments. We're going to delve into the world of covered calls and how they can be used to generate additional income, especially in the current market environment where yields might be harder to come by. We can achieve this with a covered call ETF. These ETFs employ a specific strategy that combines stock ownership with options trading to provide investors with a regular income stream. It's a popular method for those looking to boost their portfolio's cash flow. Let's take a closer look at one example, the BMO Canadian High Dividend Covered Call ETF, ZWC. This ETF is designed to provide a combination of dividend income and option premium income, all wrapped up in a single investment vehicle. ZWC primarily invests in a portfolio of high-dividend Canadian stocks. These are typically well-established companies with a history of paying consistent dividends, providing a solid foundation for the ETF's income generation strategy. On top of owning these dividend-paying stocks, ZWC actively sells call options on a portion of its holdings to generate extra income. This covered call strategy involves selling the right, but not the obligation, to buy the stock at a specific price before a certain date. The premium received from selling these options adds to the overall income generated by the ETF. This dual income strategy, combining dividends and option premiums, results in higher monthly payouts for investors compared to simply holding the underlying dividend stocks. It's a way to potentially enhance your cash flow without taking on excessive risk. As a result of this strategy, ZWC yields often hit 7–9% and sometimes even higher depending on market conditions and option premiums. This makes it an attractive option for income-seeking investors. To put that into perspective, on a $10,000 investment, a 7–9% yield translates to $700, $900 a year in income. That's a significant boost to your investment returns. And the best part? This income can be tax-free if held within your tax-free savings account, TFSA. This allows you to maximize your returns without worrying about the impact of taxes. However, it's important to understand the trade-off involved. By selling covered calls, you effectively cap your upside potential. This means that if the underlying stocks in the ETF's portfolio experience significant price appreciation, you may miss out on some of those big gains because the call options you sold could be exercised. The management expense ratio, MER, for ZWC is 0.72%. This represents the annual cost of managing the ETF, expressed as a percentage of the ETF's assets. This MR reflects the active management involved in selecting the underlying stocks and implementing the covered call strategy. It covers the costs associated with research, trading, and administration of the ETF. It's crucial to remember that ZWC is primarily built for income generation, not capital appreciation or rapid growth. Its core objective is to provide a steady stream of income to its investors. This makes it a particularly suitable investment option for retirees or anyone seeking a reliable and predictable source of cash flow to supplement their income. ZWC tends to perform best in flat or slowly growing markets where the income generated from the covered call strategy can provide a significant advantage. Conversely, in rapidly rising bull markets, ZWC may lag behind regular ETFs that are not employing a covered call strategy, as its upside potential is capped. Consider using ZWC as part of your portfolio if your primary goal is to maximize monthly income and you are comfortable with potentially sacrificing some capital appreciation. It's all about balancing your investment objectives and understanding the trade-offs between income and growth. ZWC is a specialized tool designed for a specific purpose, generating income through a covered call strategy. Before investing, make sure you fully understand the strategy, its potential benefits, and its limitations. Do your research and know what you're getting into. If your priority is pure, predictable cash flow and you're looking for a reliable income stream from your investments, ZWC is a strong contender and can be hard to beat in terms of income generation. There you have it. 3 Canadian dividend ETF strategies to supercharge your passive income in 2025. Whether you want broad diversification, sector focus, or maximum monthly income, these ETFs inside your TFSA are a game changer. What's your favorite Canadian dividend ETF? Drop your picks in the comments. If you found this helpful, hit like, subscribe, and ring the bell for more caffeinated money. Thanks for watching. See you in the next video.